Having a well-built dividend portfolio that's reliably paying cash flows to you month after month without worry is a beautiful, beautiful thing. So in today's video, I'm going to share with you how much you can expect to get from a $500,000 dividend portfolio. And we're going to jump into this article here by Smart Asset. Now, this is for $1 million, but at the end, I'll wrap up and talk about $500,000. Okay, so the article is called How to Invest $1 million for Monthly Income. And what I like about this is it talks about the dividend income, and it also talks about other income tools that also generate monthly cash flows. So first is the dividend stock portfolio. Now, a really key component that's super important for all of us to think about is not just the risk of the portfolio. That's key, but there's a saying that I'm not so worried about the return on my money, the 4%, whatever 5% that you're getting on the dividend portfolio, but they're worried about the return of their money. So choosing wisely is really important. I'm going to come back to that at the end, but let's first talk about other income generating tools that this article mentions because I think they're important. The first one is real estate investment trust. Real estate investment trusts are companies that own and manage income generating properties and are required to pay out most of their taxable income to shareholders. That allows them to avoid double taxation. And there's different niches that real estate investment trusts can focus on. There's some that focus on senior housing. There's some that focus on single-family residential units, homes that are for rent. There's some that focus on buying apartment buildings, or they're in the healthcare space, so they have offices for physicians and doctors, or maybe hospitals. Okay, the next one sounds technical, but it's really not. It's called bond ladders. And all this means is you have bonds that are maturing at different times. You might have bonds that are maturing in 6 months, 12 months, 2 years, 3 years, 4 years, 5 years. And the nice thing about this is because every year you've got bonds maturing, if interest rates start to go up, you can reinvest that money at the higher interest rate. And you can also match up when you think you're going to need the cash flow for your living expenses. You can match up when the bonds are maturing for that. And just quickly, a lot of people think of their portfolio as, maybe 60% bonds and 40% stocks. I want you to think about how many years worth of living expenses that you have in bonds so that if the stock market goes down, you don't have to be a forced seller in a down market. Okay, the next tool that this article talks about is annuities. Now, full disclosure, I'm not an annuity expert. I am a retired financial advisor. I worked in the industry for 20 years. I'm not licensed to sell annuities, and I don't want to be, but it's important that they're on your radar screen. So this author goes on to say, here's some common variants on the theme of a $1 million single premium annuity. Now, most people are not going to put $1 million in, but we can ratchet that to any amount. We could say, okay, 1/10 of that would be for $100,000. And the source for this is Schwab's Income Annuity Estimator tool, and you can just Google that to find it. But you can see here for single life only for a 65-year-old male, they would get a little over 6,300. Women would get a little bit less because they're expected to live longer, 6,124. You can also look at, so with single life only, what that means, if you passed away a year after you bought the annuity, that would be it. But the next column down is with 10-year certain. And I believe what that means is if you pass away, your heirs could get, let's say you passed away after 2 years, so there's still 8 years left. Your heirs could get, or your spouse, whoever your beneficiary is, could get the remainder of that term. So you can see what these amounts look like. Okay, importantly, the author says a single life annuity only pays income for the lifetime of the annuitant only. No payments are made after death, regardless of how soon it occurs. Okay, the next one is to buy tools, investment tools that are already designed to meet income goals. And for that, the author calls these income-focused exchange-traded funds, ETFs and mutual funds, and focusing on investing in dividends, bonds, preferred stocks, or a mix of multiple asset classes. So that tool is kind of doing the investment choices for you. Okay, the next one is rental properties. That's, a lot of us are familiar with that. You buy a house down the street from you and you rent it out. Maybe you rent out a multi-unit dwelling, something. It's a duplex, a triplex, a quadplex, sorry, or something like that. But let's keep going because I'm going to come back to the rental properties and also the dividends at the end. Okay, the next one is private credit and an alternative income fund. So private credit is giving loans to businesses that aren't big enough to get a loan on the public markets, or maybe the bank won't loan them money as well. They tend to be fairly risky. So I wanted to put it out because it's in the article, but they tend to be riskier, and you really got to know what you're doing for those. They target higher yield, but they tend to be illiquid and riskier. Okay, next one is cash reserves or high yield savings accounts. That's just the bank account. It would be a CD, a high yield account at your bank or a place like Schwab, Fidelity, Vanguard, something like that. Okay, so let's wrap it all up. Let's talk about dividend stocks. Now, I personally really, really like the dividend stock portfolio, but you have to be really, really careful with the companies, the stocks that you select to pay you dividends. If you choose it wisely, it can be one of the only true forms of what I call passive income, true passive income, because recurring revenues, recurring cash flows usually means recurring work. But with a well-constructed dividend portfolio, it doesn't have to. The work is in choosing wisely and keeping up on those investments. And it tends to be an expertise where you really need to understand the business, the operations of the business. Where are the cash flows coming from? You need to understand the balance sheet. How is the company financed? Are you taking risk? I like companies that are generating cash from the profitability of the company, and they're sharing some of that profitability to their shareholders. They're reinvesting some of it as well in their company because there's lots of good return potential in the company. So these are solid companies that are sharing part of the cash flows with the shareholders. Where I think, and you've got to be careful even with those companies, but where I think people get in trouble is there are companies that basically are borrowing money from the bank in order to pay out a dividend to investors, in order to attract investors. And there we go back to that quote, being more worried about the return of your money than the 4%, 5%, 6% or more return on your money. Okay, so this is on $1 million. The author does summarize what he feels is a reasonable cash flow expectation for $1 million portfolio, and so he says, if you spent $300,000 and put that in dividend stocks and REITs at a 4% yield, that would give you about $100 a month. $12,000 a year. I'm sorry, $1,000 a month. Okay, the bond ladder, he's saying has a yield of 3.5%. So on 250,000, that would give somebody 729. The $200,000 he's putting into a fixed annuity, and he's saying that might yield $1,200 per month. So if instead of $1 million, what this article is about, if we look at $500,000, then in this example, it'd be $100,000 in there. So the cash flows would be half of that. Same with the other for income-focused ETFs, for high-yield savings in private credit. But you do want to be careful with these investments, and you also want to plan. It's important that you have a plan, and a lot of people build their financial plan and think about how much cash flows they're going to need. They build that in Excel or Google spreadsheets. I urge you to use software designed to help you come up with a solid, robust financial plan, something that's easy to use, something that's designed for people like you and I. The software I like is called Bolden. You can find it at this referral link here. I am an affiliate. A small piece of what you pay to Bolden will support the channel. It's very affordable. As I record this, it's about $120 a month. So again, Bolden's here. It's great software. I think you're going to like it. I'm proud to be an affiliate with them. And if you like this video, the YouTube algorithm says this is the next video of mine specifically for you that you should watch next. Thanks for watching this one. Bye-bye.